Here's an analysis of the risk factors that could potentially contribute to a recession in 2025. Inflation and monetary policy. Inflation rebound. If inflation unexpectedly accelerates again due to factors like supply chain disruptions, labor shortages, or geopolitical events, the Federal Reserve might need to hike interest rates. This scenario could dampen consumer spending and business investments, leading to an economic slowdown. Analyst Torsten Slock from Apollo Global Management assigns a 40% probability to this scenario, suggesting it could lead to a rise in the 10-year U.S. Treasury yield above 5%. Federal Reserve actions. The Fed's decision on interest rates, whether to maintain, increase, or decrease them, will significantly impact economic growth. If the Fed miscalculates the timing or extent of rate adjustments, it could either fuel inflation or precipitate a recession by tightening policy too aggressively. Geopolitical and policy risks. Tariffs and trade wars. The potential implementation of new tariffs under a new administration could spark trade wars, increasing costs for businesses and consumers, thus slowing down global and domestic economic activity. This concern is echoed in posts on X, where there's significant worry about the inflationary effects of such policies. Immigration policy. Stricter immigration policies could reduce labor supply, leading to higher wages which might fuel inflation or, conversely, reduce consumer spending power if businesses adjust by cutting other costs or raising prices. Debt and credit issues. Debt refinancing. As highlighted by posts on X, there's a looming challenge with the refinancing of a significant amount of debt in 2025 at higher interest rates. This could strain both corporate and government balance sheets, potentially leading to reduced investment and spending. Rising delinquencies. Increasing delinquencies in credit cards, car loans, and commercial real estate could signal broader financial stress. This is particularly concerning in sectors like commercial real estate, where foreclosures are rising, potentially leading to a credit crunch if not managed well. Sector-specific risks. Manufacturing recession. If manufacturing stays in a recession, it could drag down the broader economy. Current indicators suggest manufacturing has been in contraction, which could spill over to other sectors if not reversed. Technology sector volatility. The tech sector, particularly stocks like Nvidia, are pivotal to market performance. An earnings miss or a drop in demand for tech products like GPUs could lead to significant market corrections. Global economic slowdown. China's economic health. A significant slowdown or recession in China could have global repercussions, affecting U.S. exports and multinational companies' profits. Concerns about China's economic trajectory are noted by analysts as a potential risk for 2025. Market valuations and sentiment. Overvaluation concerns. After a prolonged bull market, there's a risk that current market valuations might not be sustainable if investor sentiment shifts towards caution. This could lead to a sell-off and market correction. Housing market. Cooling demand. A decline in housing demand due to high mortgage rates could impact one of the key drivers of economic growth, particularly if it leads to a broader decline in consumer wealth and spending. In summary, while the U.S. economy is currently showing resilience, these risk factors, if they converge or intensify, could precipitate a recession in 2025. The interplay between these variables will be crucial in determining the economic landscape of the year.